According to Peter Schiff, the monetary policy efforts that protected us from the worst economic repercussions of the epidemic have sown a future scenario of substantially greater inflation and a global economy ill-equipped to cope with the removal of these policies. Stay tuned to find out what Peter Schiff's warning was. Hey folks, welcome back to the channel. In today's video, we'll show you Peter Schiff's warning. Before we get into this video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that post notifications are turned on so that you never miss a video from us. Without further ado, let's dive right in. Concerns about a worldwide inflation-driven recession are developing as the conflict in Ukraine drives up commodity prices that were already high due to the supply chain bottlenecks caused by the COVID epidemic. Fears of a financial disaster as a result of such a recession have already dampened market sentiment, with the S&P 500 index in the United States down 7% from its January record high, and the Nasdaq Composite down 13% from its November all-time high. The US dollar and gold have provided traditional safe havens for investors, but how safe is the US currently if a financial catastrophe and recession are on the way? Euro-Pacific Capital CEO and chief global strategist tells Capital.com that he believes a financial crisis, even worse than 2008, is on the horizon. In a Capital.com debate with Steve Keen, the award-winning economist and author of Can We Avoid Another Crisis?, the financial heavyweight made these remarks. Payments to furloughed workers, record low interest rates, major asset purchase programs, or quantitative easing, QE, corporate help, and other policies have laid the groundwork for ongoing spending during the pandemic-driven economic slowdown. According to Schiff, this built-up latent demand during a period of tight supply has resulted in increased rates of inflation over the world, laying the groundwork for a future crash. The Federal Reserve, the Fed, can no longer explain this monetary strategy. Therefore, if they have to withdraw it, everything that was built on top of it will crumble. Governments replaced lost wages, but they didn't replace lost production. They can create as much money as they want, but if people aren't working, the money they produce has no value, and prices will rise as a result. And we're only scratching the surface. The supply shock has been exacerbated by Moscow's war with Ukraine, which has resulted in Western sanctions restricting Russian energy, minerals, and agricultural commodities, as well as China's continued limitations due to its zero-tolerance stance on the spread of COVID. While a recession has always been a risk, we're concerned that the chances are growing and it may become the default scenario, says Mark Chandler, managing partner and chief strategist at Backburn Global Forex. Is the financial market catastrophe, on the other hand, an unavoidable result of a recession? As inflation rises, Schiff argues that such a crisis would be dollar-driven. I believe that long-term consequences are very negative for the dollar, Schiff adds, because I believe we're highlighting the vulnerabilities that other countries face as a result of the reliance on the currency. He goes on to describe how the United States has weaponized the dollar against Russia through sanctions implemented in response to Russia's activities in Ukraine, and how China and other countries might be exposed, as a result causing a massive sell-off in dollar reserves. China opposes the employment of that weapon against it. China has significantly more money than Russia. We believe they want to get rid of their money. We believe Russia, China, possibly India, and other countries want to intensify their efforts to reduce their reliance on the currency. Is it a crash or a correction? So when should investors expect a market crash, or at the very least, a steep correction, if not a full-fledged bear market? What signals should they be looking for to warn them that it's on its way? Many of the criteria are already in place, according to Russ Mould, AG Bell's investment research director. Mould cites an over-leveraged financial system, a frightening buildup in derivatives amounting to $3.5 trillion in stock, and index-based options expired, frothy initial public offering and mergers and acquisition markets, overconfidence in central bank backstops, and the long bull run leading to overvaluations as examples. All the gasoline-soaked logs are in place, and the kindling is placed around them. All that's left is to find a match. However, you could have made the same argument at practically any point in the last decade. Policy responses have ridden to rescue, but as China is discovering, this only exacerbates the underlying fragilities, making management more difficult. While there is clearly some froth in stock market values, particularly in the high-growth tech sectors of the United States, will even a significant sell-off trigger a crash that poses systematic damage to markets, including the demise of the world's most powerful market totem, the dollar? Mike Coop, CIO at Morningstar Investment Management, EMEA echoes the sentiment, claiming that market corrections are a normal part of the process of bringing inflated valuations back to more reasonable levels. Market corrections are even welcomed by experienced investors who can recognize indicators like those stated by Mould above, who take profits on assets in their portfolios that they believe are overvalued and buy back at a lower price once the sell-off has subsided. Is a financial crisis in 2022 a possibility? Schiff presents a scenario in which the Fed will need to intervene quickly to avert a cascade effect that will drive inflation higher in the future. The only way to stop this is for the Fed to entirely reverse course and allow interest rates to skyrocket, shrinking the money supply while ignoring the short-term implications of defaulting firms and governments, bankruptcies, unemployment, collapsing banks, and depositors losing money. However, just a few other analysts see the same dramatic scenario unfolding. Back in those days, you had a growth that was dying and inflation at 12%, says Alan Oster, chief economist of NAB Group, referring to the period of stagflation created by an oil price shock in the 1970s and 1980s. That's no longer a topic of discussion. At this point, all central banks are aware that they do not want to repeat the mistakes in 1982. People believe that oil prices wrecked the economy in the 1970s and 1980s, but it was the central banks' response to the oil price shock that did so. Hopefully, we won't have to deal with that again. In a research report, Goldman Sachs claims that the recent drop in the S&P 500 shows a 40% chance of a US recession, which would result in substantially weaker valuations and profitability. Our analysts predict a 20% to 35% risk to a US recession, which is in line with models based on treasury yields. Recessions frequently cause stock values to fall, but they don't always result in market crashes. Based on the median, the S&P 500 has declined around 24% from peak to trough throughout previous recessions. However, the index has returned 15% over the next 12 months when the US economy avoids a sustained contraction after a 10% market correction. The dollar may be down, but it isn't out. What about the greenback? Well, it's likewise in danger of collapsing and losing its reserve status, which it's held for decades. According to BIS, Bank of International Settlements, the dollar has declined by an average 4% over the last 4 tightening cycles. Capital Economics' Neil Shearing agrees. He admits that when alternative trading blocks form, such as China and some of its Asian neighbors, who transact cross-border details with the yuan, the global financial system may become more fragmented, but he believes the dollar will continue to dominate. Is there a chance of a financial crash? In fact, there's no clear answer to this question, though most analysts do not believe a crash is imminent. True, an equities market downturn has begun, at least on the Nasdaq Composite in the United States. Indeed, it was down 21% from its recent top at its lowest point this year, and technically, a fall more than 20% is considered a bear market. However, following a long bull run, market declines are expected. Corrections drive asset prices down to levels where investment may resume in earnest, just like how forest fires clean out dead and aged wood to make place for new growth. Many of the world's economies are undergoing a time of slower growth and greater inflation, as seen by the comments above, and central banks must tread carefully in dealing with these dangers. While we can look for early signals of a market crash, the nature of boom and bust means there will always be cycles where the economic activity slows for a time. To protect themselves from such dangers, investors must concentrate on value and ensure that they pay prices that provide both downside protection and upside possibilities. This is when FOMO collides with Pongo, the agony of not being able to get in the way. Did you find this video informative or helpful? Let us know in the comment section below. Make sure to subscribe so you don't miss out on any future videos. Don't forget to like and share. Take care.